Good morning. Good morning. You know, this is like my favorite event of the year. I've been, of course, working with EDA way back when it was called EDA, for those of you who remember, and I was still with UCLA. Of course, times were very good then, but unfortunately, as you know, during the time period, I was quite worried about some of the trends I thought happening in the local economy, and sadly, a lot of those predictions came true. And it's been a very rough set of years, particularly for the East Bay, which obviously was driven into some very, shall we say, hot economic growth as a result of the real estate boom. Well, I'm in front of you today, and as you can tell, I'm about as optimistic as I've literally been since I started doing these talks. Because what we see today is a lot of good news. Now I realize you dip into the newspaper, you start looking at some of these headlines, and it doesn't seem like it's so good. But indeed, if you kind of scratch away and understand that the opinion of the press is often a lagging indicator of what's really happening, if you look at the fundamentals, particularly here in the East Bay economy, what you see is something different, which is to say, an economy that really is moving forward. So obviously, U.S. expansion is actually gaining some speed. 2012 ended strong, and then it's carried over into the first part of this year. Consumer spending is stable, despite the fact that we saw these higher taxes. Employment picture is definitely getting better. Real estate is in full recovery mode. I didn't get into this morning's presentation, but the Case-Shiller numbers came out, and it's a little kooky what's going on in real estate right now. Huge increases in prices across the board, and that has positive ramifications for the state, national economy over the course of the next year or two. We'll get into that quite a bit. Business investment's been holding steady. Production is growing again, although at a slow pace, largely due by a weak overall path of exports. State and local government starting to turn the corner, and yes, California and East Bay are rebounding quite strongly, much to our critics' chagrin. As you know, over the last few years, we've heard nothing but the ongoing cries of certain groups of individuals in our state who told us that California is more or less a dried up husk because of our bad taxes, bad business regulations. Forget about it, pack up, move, because this state's just an awful, awful place. And every time I get on the 405 in the morning and it's wall-to-wall with cars, I actually wish that was true, all right? Unfortunately, it's not. Our economy is moving forward. Now that, to no way, shape, or form excuses some of the nonsense that does go on in Sacramento and some of the things that we do have to work to change as residents of this particular state. The work that Karen does with the EDA is also important for pushing those efforts down the tracks, if you will. But at the same time, don't let these issues be overwhelming in terms of your view of the California future. Because ultimately, if people want to live here, business is going to occur here. And candidly, people want to live here because it's paradise. Always keep that in mind. Is everything perfectly fine? The answer is no, obviously not. From a long-term standpoint, we have a long ways to go to get back to normal levels. But the housing market's going to help. This year, we're dealing with the headwinds of unwinding some fiscal policy. Next year, we'll probably be dealing with similar sort of headwinds from unwinding monetary policy. And of course, non-residential investment is lagging. If you had to sum up what are the biggest risks today for the East Bay, for the U.S. overall, it really boils down to one thing: politics. Ultimately, what we have is a nice, solid momentum starting to build in the U.S. economy. We're going to start moving forward. What could derail this is kooky politics, primarily coming out of Washington, D.C. The biggest single risk is what's going to happen later on this fall when it comes time to expand the debt ceiling. Now, I'm not for a second suggesting that today's massive deficits being run by Washington, D.C. is a good thing. But at the same time, I also appreciate that now that we're on this path, we have to work our way out of it slowly and gradually. That doesn't mean turning it off overnight by not allowing the debt ceiling to raise. If they indeed prevent that from happening, it could be a mess. The other big issue, of course, is something a little more long-term, and I have some slides in here because I think we can start thinking long-term again. Obviously, we here in this state, and of course, for the nation overall, need to start tackling some of those tough issues having to do with the national entitlements reforms that we so desperately need. Another conversation, and really needs to start beginning now. Now we have the space to start having these substantive conversations and understand that these things are going to start becoming critical within the decade and a half, which means we need, again, to start making movements now and then. And of course, that doesn't seem to be even possible in our current political climate. So that's the big picture. Let's just get right into it. As already noted, the GDP numbers actually look better. Now, I know, you say, well, GDP, you know, it's been pretty weak, 0.4 in the fourth quarter, 2.5%. But keep in mind, that's the headline number. You've got to scratch away, get down to the underlying details. Indeed, if you look at private sector demand, we've actually had a very solid surge in overall private sector demand from businesses and consumers over the course of the last couple of quarters. Indeed, two of the strongest quarters for overall demand from businesses and from individuals that we've seen over the past 3 years or so. What's keeping those numbers negative is partly inventory, which is kind of this transitory thing that bounces around, but also a lot of it has to do with the fact that we've seen defense spending cut back quite significantly over the course of the last couple of quarters. The cutback in defense spending, of course, is what I would call sequestration 101. Remember, this year we are having some substantial cuts in the federal budget. The Defense Department doesn't have the luxury of waiting to see what happens. They have to get ahead of the curve, and they are. Interestingly enough, they were supposed to cut their spending this particular year by $45 billion. They've already cut it by $55 billion. So they're actually ahead of the curve, which means part of the sequestration pain is already behind us. Good news looking forward. As noted, consumer spending has been bouncing forward very nicely. In fact, the first quarter of this year was one of the best quarters for consumer spending growth we've seen in over 3 years. And that's, of course, is quite a surprise to some folks because we have these big tax increases that began at the beginning of the year, about $120 billion or so. And that, of course, is also here in the case of California with state taxes going up as a result of Prop 30. Now, it does look like consumer spending is slowing down some in the second quarter. There's no doubt about that. The growth rate is slowing down. I think there is some residual effect of the taxes going up at the beginning of the year. Second quarter probably won't be all that good for consumer spending, but it's not going to drop off a cliff either. And the reason for that, the reason consumer spending has so much momentum in it, is because even though higher taxes are higher today, people are actually getting more income today. Indeed, disposable income today, that is to say income after taxes, is higher now than it was last November. Because of the fact that we are seeing a fairly solid increase in consumer wages. And that's the first time this has really happened since the recession came to an end. Indeed, over the last bunch of years, it's been mainly corporations that have been making a lot of money. This time around, it's finally, some of that wealth is trickling down to personal income, and ultimately that's a good driver for where this economy heads over the course of the next couple of years. It's also because employment is a little better now than it has been in the past. It's interesting because, again, if you sort of scratch away at the surface, you forget about the month-to-month numbers. The month-to-month numbers are very, very noisy. They bounce all over the place. There's a lot of variance. There's highly subject to revision. What you want to do is look at little blocks of time. And you look at like what happened, say, 8 months ago, from April, August last year, about annualized pace, about 1.6 million jobs. Not very good. But look how it's heated up over the course of the last 8 months. Now we're running in kind of the 2.3, 2.4 million jobs per year pace, which is a solid number. That's a good, solid thing that pushes forward. What's added to that, on the far right side, you can see some of the acceleration figures, kind of the change, if you will. And the big drivers are admin support, construction, accommodation, retail. It's consumer spending, businesses hiring folks again. That's pushing things forward. Solid numbers there. Consumer finances are also considerably better now than they were a few years ago. And on one hand, you have overall household aggregate net worth getting almost back to pre-recession levels. You can see the next bounce back there. Not because of housing, although housing is going to start adding to it in a very significant way, but largely because of the bounce back in financial markets. Not the least, of course, is the stock market, which has gotten back to near record levels. It also has a lot to do with the fact that right now, because of low interest rates, the debt burden being faced by American households is fallen to the lowest level ever. Now, you'll hear all the time how consumer debt levels are very, very high relative to income. But that doesn't matter. It's a cost of the debt, the interest rate, that's important. And remember, interest rates today are amazingly low. A decade ago, if you went out and got a 30-year fixed rate mortgage, you'd be paying easy 7%. Today you're paying 3.5%. And what that means is that debt is extremely affordable. Indeed, right now, if there should ever be a time when the banks are opening up the spigots and lending to folks, particularly when it comes to home mortgages, this should be the time. That still hasn't occurred, which in a very real sense is a simple policy lever they could turn and really get this momentum that building in the economy to take off even that much more. Unfortunately, they haven't done that at this particular point in time. And how real is the stock market? That's another big question out there. Everybody says, well, the stock market, all-time record highs, yet we're still trying to struggle to throw off what happened in the last downturn. Could this be the real deal? Well, look, folks, the stock market does not reflect the broader economy. Never think that. That's completely incorrect. The stock market reflects two things: interest rates and corporate profits. And corporate profits are also at record high levels. And oh, by the way, interest rates are also very low. You add it up, and indeed from a long-term standpoint, you could argue the stock market today is undervalued, not overvalued. That there's significantly more headroom there till it gets back to, shall we say, normal levels of capitalization. Now, that isn't a suggestion to go out and buy equity, although you probably should. Remember, I've said it before, I've said it again, it's the 13-year-old daughter of the U.S. economy. It's the ultimate drama queen, right? You got to have a taste for volatility to be in the equity markets. That's just the nature of the beast. But from an underlying standpoint, clearly, there's headroom in these equity markets, and that could push things forward. Industrial production has been bouncing up just a little bit. The ISM surveys remain above 50. Not quite the big boom we saw in 09 and 2010, 2011. Things clearly slowed down last year. But again, it hasn't fallen. It's still climbing at a relatively slow pace. You see C&I loans continue to expand. C&I loans, commercial, industrial. These are small loans made to businesses for building up inventories, for small capital investments. They continue to grow, good size, but continue expanding economy. And durable goods orders have bounced back just a little bit. Volatile, which you see is growing very slowly over the course of the last year or so. Not the best signs, but again, at least not falling off the cliff at this particular point in time. Now, where are all those jobs? Well, as already noted, I'm proud to say that California indeed is number 8 on the list in terms of overall job growth, which a lot of folks out there still can't fathom. Again, they've been telling us for the last 3 years that our state's done for, that businesses are lined up on the border like Oakley's in reverse, desperately trying to move to Texas because we all know that Texas is heaven. But indeed, it looks like the opposite is true. California has indeed added about 2% to its workforce, about 273,000 jobs. That's number 2, yes, behind Texas, no doubt about it. But what's interesting is we're actually undercounting jobs. We get a quarterly report from the EDD that tells us about where we are. Remember, these are surveys. The surveys regularly get revised. We get new benchmarks. Well, the new benchmark's already suggesting that there's 100,000 more jobs in California than we're currently counting, which would, yes, indeed, put us above Texas at this particular point in time. Worthwhile noting, okay? So our state is indeed moving forward. And you see it other places as well. Our unemployment rate's dropping faster in other places, down to 9% all of a sudden. Still high relative to the U.S., but falling at a faster pace. You look at overall household employment index. This, of course, is based on where you live, and it's a survey, the current population survey. You can see how fast we've been growing. Indeed, relative to 2003, California has now surpassed the overall U.S. in terms of household job growth. At this particular point in time. Very solid size of kind moving forward. There's a lot of numbers on here. You got to download the slides as well. What kind of jobs? Where are those jobs? Well, top of the list in the state, accommodation and food service. Tourism's back, but number 2 is professional scientific services, construction, admin support, healthcare driving the show. As for where the jobs are, well, they're across the map, really. Napa, Sonoma, San Jose, obviously San Luis Obispo. You see some of the tech areas, some of the wine country. We'll come back to that in just a second. But East Bay is definitely in the midst of 2% growth on a year-on-year basis, up something on the order of 18,000 jobs from year to year. Fairly good numbers there. You can see unemployment dropping across the region. Indeed, unemployment here in the East Bay is about a little above 7% at this particular point in time. It's been a long time since it's been that low. Again, very solid signs. People are going back to work. And you can see where the area is right now. Here's the East Bay, the white line here, growing fairly decently, a little bit behind the San Francisco area, but nonetheless growing at a very solid basis right now. What kind of jobs in the East Bay? What's growing overall? Well, these are through April. They dropped off a little April, but it's probably going to get revised jobs. But 1.4% overall. Admin support, educational services up 5%. Leisure, hospitality, again, hotels doing really well. But look at this, professional scientific services, 3.5% growth on a year-on-year basis. These are high-end jobs, high-paying jobs. And a lot of those particular sectors, very good signs for growth in the local economy. Population starting to grow again. There has been a bit of an overall tailing off of immigration, but you see domestic migration is coming back very strongly. People are moving back to the East Bay. Good signs there for the local economy. What kind of growth are you seeing out there? Number 1, San Jose, of course, up 1.31%, but you see here we're growing about 1.26% over the year-to-year basis. Fremont, Berkeley, a little less than that. But again, positive numbers across the board. People are starting to move back. You're seeing the growth. People are coming here because there's jobs and there's still relatively affordable housing, at least for now. Personal income's growing. State taxable sales back to pre-recession levels. Very similar sort of picture here. You can see East Bay has actually surpassed where it was back in 2008. Again, tailing off just a little bit over the last couple quarters, but a lot of this has to do with business spending. There was a big spurt in business spending in the middle part of last year. Of course, they pay taxable sales. That's one of the things that Jerry Brown wants to remove. It's one of the things he wants to get rid of is manufacturing companies having to pay taxable sales in some of their investments. Nevertheless, you can see the numbers are still relatively good from where they were a year ago. On the right-hand side, I break down some of the local cities. Berkeley up the most, actually 6.9%. Actually, Richmond's up the most at 11%. Where are taxable sales increasing? Autos and transportation up there quite a bit, but building construction also doing quite well. And here's that business and industry mix I was telling you about, year on year, up about 5% at this particular point in time. Ports are busy. If you look at the airports, very solid signs of traffic increases there. Oakland's doing great, 10% year-on-year increases, at almost as good as SFO. Behind that, Long Beach, you can see like Los Angeles, San Diego, well behind. And of course, the port as well is doing. The port is seeing a lot of export growth there as well, slowing down a little bit in 2012 relative to 2011, but significantly above where it was back in 2006 and 2007. What kind of stuff is coming out here from the ports? Well, mainly the big increases, of course, are in edible nuts and fruits. That's the big thing, of course. We know there's a huge increase in exports of these products, primarily to Asia. Huge demand for these products. A lot of them come right through the port of Oakland. But industrial machinery, also doing particularly well. At this particular point in time, a little bit of electrical machinery as well. Tourism also doing great. In hotel occupancy rates in the state up to about 70% right now, back to pre-recession level. And it's interesting because there's a whole new mix of people coming to the United States right now. If you look on the right-hand side, Canada and Mexico, always, of course, the greatest number of visitors coming to the U.S. shores. This is national numbers. We don't get these for California too much. There are some numbers out there. You see Japan's bounced back nicely since the tsunami that happened a couple of years ago. People from Germany coming in. But then the new places coming in, Brazil, Argentina, Venezuela, Colombia, 20% across the board. South America is doing great, and they're coming up here for all sorts of reasons, tourism, buying real estate, things like this. Most impressive, though, look at this right here. People's Republic of China, a 40% increase in visitors from the PRC in 2012 relative to 2011, and that's not slowing down. They have money, they have passports, and they are coming to California in a very big way. And by the way, a lot of this is tourism, but it's not all tourism. A lot of it's also business, as we know quite well now. Where are you? My EB5 guy, regional center. There you are. Yeah. So we've actually done some work on the EB5 project. I'm not sure if you're familiar with the EB5 visa program, but here's how it works. Basically, if you invest at, $500,000 minimum?
Yeah, 500,000.
500,000 minimum. For every 10 jobs you create, you get a green card. It's a program that's been in place a long time. It's really over the last 4 years that the ICE has finally gotten it. They finally get it. They know how to do it, and they're processing it. And there's a lot of money coming to California. A lot of money coming to East Bay as a result of these particular programs out there. So it's very interesting. Keep an eye on that as that moves forward. Hotels busy again in the East Bay. You can see the daily rates are coming back very nicely at this particular point in time. Consider better back where they were back in 2010. Running about $100 right now, up from $80. That's a 25% increase in 2 years. That's a solid bounce, and of course good for local coffers. Venture capital has been moving, is kind of doing okay overall for the area. But if you look at East Bay venture capital, you can see the decent what's happening here overall. Year-on-year change as of the first quarter 23, about 36% up. Biotech, the big receiver of new money, as well as medical devices. You see a shifting towards those things. A little bit less in consumer products, electronic industry, and industrial energy, but again, moving to biotech and medical devices. Money coming in a little bit, of course, in software as well. Probably most important, forget everything else. If you have a wine cellar at home, empty it now, okay? 2012 was the best wine year we've had in California in literally decades and decades. Not only do we have a record crop being pulled off in terms of tonnage, there was a record amount being paid for those particular grapes. If you remember your old supply and demand graph, that's not supposed to happen that way. If you have lots of one, you're not supposed to have a low on the other side. But it's the quality of the grape is so good. Empty the wine closet, start buying in 2012. It's going to be amazing, and you have to do it quick because you want to look at another place that exports are booming. Of course, it's in wine. Well, people are coming over here, they're buying our nuts, their fruit, and they're also buying our wine. Where's all that going to? Well, top of the list, our biggest increase in the absolute terms, Canada. They're all trying to stay warm with our wine. They're California dreaming, right? But after that, you have Hong Kong and China, and down here is Vietnam. Look at that growth rate over the last 3 years of Vietnam. By the way, that's not actually Vietnam. That's China. This is coming through Vietnam. Same thing with Hong Kong there. But they discovered our wine in a big way. Another reason they're coming here. Now with all this, I can't say that this has been a great recovery. Obviously, well, there's good signs right now from a long-term standpoint. Things are still way behind. If you look at a normal path of recession, we would hit bottom and quickly bounce back. Why? Why are we so far behind? Why can't we catch up? Well, you know, if you go back and you sort of think about this last election we just went through, and you listen to what Obama was saying, and you listen to what Romney was saying, the underlying subtext was more or less what's wrong with the U.S. economy. And I can say in complete bipartisan spirit that neither side had any clue what they were talking about. Right? On the left, it was all about the consumers and these terrible foreclosures and how we need to get rid of some of this consumer debt and stop foreclosures and consumers can start spending again. Consumer spending remains at an all-time record high level in the U.S. economy, folks. Indeed, from a long-run standpoint, we are still overspending, not underspending. We need to be saving more, spending less, and start preparing for a point in time where Medicare, Social Security, Medicaid aren't going to be there for us, because guess what? They're not going to be in their current forms. It's simply not affordable, as simple as that. And of course, this idea that somehow or other foreclosures are killing consumer spending, I have yet to see any shred of empirical evidence that that is indeed the case. I agree, a foreclosure at the personal level is a complete tragedy, but ultimately, remember, our foreclosure system as it exists is actually a good thing. And I was thinking, how can it be so good to take a house away from people like that? Well, let me put it in context. 200 years ago, in England, if you were foreclosed on, they'd throw you in jail, okay? In Spain, today, if you're foreclosed on, the debt doesn't go away, folks. That's not tied to the house, it's tied to you. If you're foreclosed on in Spain, you're paying off that mortgage regardless. Today, in the U.S., you got swept up in the chaos in 2006. You bought a home you shouldn't have bought at a price you shouldn't have paid for it. You foreclose, the debt goes away, yeah, your credit score takes a hit, but you know what? Clean slate, you start over. That's a good system. Simple as that. Move forward, move on. And that's a good system. On the left, on the right, of course, it's all about taxes. I won't go through this too deeply, except for to say that we've had, over the last decade, some of the biggest taxing decreases we've ever seen, huge tax cuts. It hasn't brought us a decade of prosperity. As much as I believe smaller government, more efficient government, at the same time I also recognize that the empirical evidence does not suggest that lower tax rates stimulate economic growth. That's simply untrue. And I don't care how many folks on the right want to say it over and over and over again, lower taxes causes growth. They don't. It's as simple as that. We can have the debate, but let's keep it at intellectually honest level. Telling me that cutting my taxes is going to stimulate more economic growth is simply untrue. Period. What's the problem out there? Trade deficits in construction. Construction peaked at 9%, still running about 5%. Trade deficits still running about 4% of GDP. You close the trade deficit, you get the construction markets moving forward again. We're back to normal levels. On the trade front, the news isn't all that good. Indeed, over the last couple of years, trade is more or less flat, both in terms of imports and exports. Nothing happening there. It's not that we're not competitive. Indeed, from a long-term standpoint, the dollar, real value of the dollar today is the lowest it's been in 15, 20 years. We're about as competitive as we possibly could be at this particular point in time. Very good news. Ultimately, that is going to benefit California because we're such an export-heavy state. But in the short run, the problems out there, of course, has to do with the fact that the world economy isn't doing well. And yes, we're feeling it right here in the state as well, where exports have more or less been flat for the last couple of years. Well, what's happening in the rest of the world? Not much is the answer. On one hand, Europe is still mired in a recession, although at least we can say that the crisis has been taken out of the problems over there. I mentioned this last year. I said, look, there's a simple solution to what's going on in Europe, and that would be the European Central Bank to stand up and say, we will backstop government debt, which is what they did in the middle of last year. It doesn't fix the underlying problems of an uncompetitive Southern Europe and too much debt currently in the system. But at least in the short run, there's no massive threat of a collapse of one of the economies, somebody defaulting on debt, and the ultimate collapse of the euro. That's no longer in the cards. So we've gone away from crisis, we're in a chronic situation. The answer is they still haven't fixed it, but at least things have stabilized, and that's about as best as you can hope for. As for Japan, a little better news there. They finally have some real stimulus. Their economy's starting to grow. People are saying, well, that's a currency war. Got to be careful on that particular front. Remember, on one hand, it is true the yen has come down a lot, but that's coming down from really high levels that were unreasonably high, driven there by folks working on this carry trade thing that Wall Street does in order to make some short-term money and a safe sort of position. Ultimately, Japan with a lower yen is going to start growing, and as they start growing, they'll start to import more stuff, including more stuff from the United States, and that can be a good thing for the world economy. As for China, they continue to grow. While it is true that overall value added in industry is only growing about 10% year on year, retail sales continue to climb, of course, and overall home housing markets prices continue to climb as well. Their economies continue to grow, and candidly, they are over here. They're investing, they're buying stuff, and they're being a very powerful force for global growth. Also good news for the U.S. economy is overall energy gains. 25% increases in both natural gas and oil production. This is the real deal. It's not going anywhere because of new technology, and ultimately that's going to reduce our demand for imported energy products, and that's a good thing. Ultimately, we do need to get green and get smart and reduce global warming, but I know at least in the short run, we're still going to be dependent on oil products for the short term, and I'd rather make it here than haul it from overseas. It's a good thing for the U.S. economy. What about our oil here in the state? The Monterey Shale oil, biggest deposit in the U.S., but keep in mind, we can't use it yet because it's too fractured, it's too crazy. The places they can use the new technologies are in North Dakota and places like Texas where it's just flat. And you have these oil reserves that are a nice flat plain going on for hundreds of miles in every single direction. That's not true here in California. Our geological history means that these things are tossed all over the place. Every time you have an earthquake, you got these things fractured in every direction. You can't get to it yet. They're trying, they'll figure it out, give it 5 years or so, but not quite there yet. Probably most important for the economy today has to do with the fact that the housing market has absolutely taken off, and I'm going to. So if you look at the numbers, no doubt about it, you see overall sales continuing to increase, prices growing at a very solid basis. We've got the Case-Shiller numbers for March today, which is a moving average of February, March, and April. And again, also showing home prices rising at a very, very solid basis. You look at some of the numbers, just over the left, these aren't unfortunately the newest numbers, but to give you some idea, San Francisco, which includes both East Bay and San Francisco, from February to February, they grew at 19%. Just the last 3 months, they grew at a 25% annualized pace. This is Case-Shiller, folks. That means it's quality adjusted to give you some sense of what's going on out there. The markets are on fire. There's no doubt about it. Why is that? Inventories. There's almost none out there today. And you know, this is kind of predictable. Remember, prices are the lagging indicator in the markets. Inventories are the leading indicators. Those inventories have been falling for a couple of years now, both for new homes as well as existing homes. Overall units for sale, according to the HVS report, you add it up, what you're dealing with today is a very, very tight market, and tight markets lead to bidding wars, and bidding wars drive prices up across the board. You see in California, where prices have dipped from about 250,000 close to 300,000, we're running just over 2 months supply. It's 5 months supply in the nation, less than about 2 months supply here in the state, to give you some sense of things. Getting you a little closer to home, you can see the East Bay here. I mean, it hit the bottom at about 310,000. It's 400,000 now in East Bay, folks. It's through the roof, the median prices. Home sales, not up that much. It's a very weird recovery because you're not seeing it in sales, but you're absolutely seeing it in price increases, again, because of these overall tight inventories. Foreclosures are way down. You look at the East Bay here, both defaults and foreclosures for the first quarter, absolutely collapsing. The so-called foreclosure crisis, it's not even there anymore. It's interesting, you know, you go back 6, 7 months ago, and we heard all this nonsense at the state level about how we needed a homeowner's bill of rights and these foreclosure reforms because that's what was so desperately needed to fix the housing market. The housing market's been fixed, folks, just by sheer time and energy and the fact that we're over the hump on this. Demand is pushing stuff forward at this particular point in time. Yeah, okay, so in terms of inventories, again, looking across the area here, Alameda, 2.2 months supply. Contra cost 2.2 months supply. Folks, these are crazy low numbers. I mean, it's just incredibly tight at this point in time. MBA data, there's not much in the pipeline out there at this particular point in time. You look at, is there shadow inventories? There's no shadow inventory out there. There is a certain number of units in the U.S. In foreclosure, there's no doubt about it, either in the process of being foreclosed on or REO. But overall REO units in the U.S. running a little less than 600,000. Not to mention those actually in the foreclosure process, but most of those are in the judicial states, such as Florida, New Jersey, places like that. It's not here in California at this particular point in time. It really is very little going on out there. Now, one of the big questions out there, of course, is this a bubble? And it's funny because the same reporters asked me today if the bubble is the same folks a year ago asking me when we're going to hit bottom. And to give you some sense of how fast this thing has turned around. And the answer is, the reason it's turned around so heavy is not because we're in the midst of another bubble. It has nothing to do with flippers, it has nothing to do with investors. It has everything to do with the fact that really, for all intent and purposes, we've been in a negative bubble for the last couple of years. Remember, how do you talk about a bubble? What is a bubble? A bubble is when the fundamentals, that is to say incomes and rents, don't support what's happening in homes. If you see incomes flat and home prices are going up, you have a problem. If rental prices are going down and home prices are going up, you have a problem. And that's where we were in 2005. But today, it's quite the opposite. Indeed, if you look at home prices relative to incomes because of these low interest rates, affordability is about as good as it's ever been. If you look at home cost to rents, that is to say, the cost to buy a home relative to renting an apartment, you've never seen homes as cheap as they are today. There's a very good reason why homes are going up in price so much, because candidly, from a long-term standpoint, they're way too low. Now, ultimately, this for me is a wasted opportunity, because if you look at this kind of market, the middle class in the U.S. was mugged over the last 5-6 years. Simple as that. There's no other way to put it as what happened through this last overall housing cycle. There was a huge shift in wealth in the U.S. from the middle class to some of the folks at the top end. This is an unprecedented opportunity for those folks to make some of it back by getting into the housing market today. But what do you see? It's very, very hard to get, and I have this data here, very hard to get credit at this particular point in time. Still very tight for homeowners, for new homeowners to go out there and get money. And it isn't being helped by the fact that over the last 3 or 4 years, the banks have been turned into the bad guys out there by this sort of policy machine in Washington, D.C. Well, the banks were never the bad guys, folks. It was the big investment banks. They were doing some nasty stuff. And it was all these subprime guys out of Orange County who all, by the way, went bankrupt in 2007 before we even knew we were going to have a massive financial crisis. But it's not your sort of rank-and-file bank. These are the guys who should be lending like nobody's business right now, and yet they don't really have the opportunity because, candidly, the regulators won't let them. And this, to me, is sad, because what it means is the folks who have a chance to get into this market and take advantage of it are those who, candidly, already made a lot of money. That is to say, the big hedge funds and the investors. As for the state overall, keep in mind, while it's nice to see prices going up, and it's going to do all sorts of wonderful things for our economy, because it's going to be driving forward overall consumer spending, because people can start actually pulling money out of their home again, and obviously you're going to have more building going on. At the same time, California already has the least affordable housing market and the lowest vacancy rate in the nation. We, as a state, while we need to say, hey, this is great, the home prices are going up, it's going to be a nice lift for our economy, also recognize that it's going to take the pressures of high housing costs and make them even more intense. For the East Bay, you're kind of in a mixed position on this. The fact that San Jose and San Francisco are so expensive means people are going to be moving here, and that's going to drive the East Bay forward in a very big way. More people living here, moving this economy forward, and that's good ultimately. But keep in mind, for the state to succeed, particularly, say, for example, manufacturing, you got to have affordable housing, as simple as that. Remember, Texas, low budget, small government Texas, has more public employees than we do as a percent of their workforce. Let me repeat that. They have more teachers, more firemen, more policemen than we do. How do you get away with that? Well, they pay their average person 30% less than we do. How do they get away with that? The cost of housing is half what the cost of our housing is. We desperately need housing reform. We need to have an easier, quicker permitting process. We need to have those permitting fees way, way pushed down. And on top of everything else, we desperately need CEQA reform in this state. You know, the governor talked about it. He said it out loud. It's God's work. He's already backed off of it because he's got other priorities. Apparently, it's not that godly a work. As for local permits, they are starting to pick up some, but still relatively low from a long-term standpoint, no doubt about it. Here's some of the issues here. I'm sorry, we're running low on time, so I'm going quick through this again. This we put on the website so people can go through it. As for other construction activities, still relatively flat, not a big surprise there. If you look at where vacancy rates are, for example, in office space, still 26% in the East Bay, 27% vacancies retail in the East Bay. But it's not just the East Bay. Look at San Francisco. I'm sorry, it's a 16%, 18% vacancy in the East Bay for office space. If you look at San Francisco, it's still 13% vacancy rates. What you're dealing with here, of course, is some fundamental long-term trends having to do with information technology. Now, today you don't need to be in the office as much as you used to, and that means they don't need as much office space for employees. Simple as that. When it comes to retail and office, it's not going anywhere. But the stuff that's going to do really well is what I would call sort of the destination stuff. The downtown office space is doing great. The suburban stuff, not so well. the fancy malls, which have the cool fountains and the things for kids to do, they're still pulling in tons of people, but again, that corner market not doing so well. The shift in the market, again, largely due to information technology. As for non-residential permits, a little bit of activity going on there, not too much. Alterations are down, but commercial is popping up just a little bit. Contra Costa seeing some nice numbers there. Biggest source of uncertainty, I've used this slide every single year for the last 3 years, only because they keep proving it so completely right. This bright cartoonist back in 2010 asked a fundamental question: can the U.S. economy survive a double dip? Much more fundamental question is, can the U.S. economy survive 535 dips? Obviously, what I'm referring to here, of course, is the fiscal cliff, the so-called man-made crisis we have with our government budget. Look, I don't approve of the deficits that Washington, D.C. has been running, because largely they've been used to give people tax breaks. They've used those tax breaks to go out and spend more money to buy primarily stuff made in China. Or if I may sum it up, our fiscal policy has been more or less, let's borrow hundreds of billions of dollars from the Chinese in order to stimulate the Chinese economy. Well done. But you can't work your way out of it slowly, you can't work your way out of it rapidly once you're there. It's very simple. When it comes to government policy, you have to have slow movements. Slow movements because the economy is like a piece of plastic. You bend it slow, take whatever shape you want. You bend it fast, it snaps. Simple as that. These things have to be phased out over time, which means, yes, cuts in spending as well as increases in taxes. We had some increase in tax. We had a $130 billion hit. We're currently going through the sequestration. We're halfway there. So we see most of the pain is actually behind us at this point in time. There are some multiplier effects to deal with, but for the most part, we can move through the current policy. The big thing that scares me, of course, has to do with this, again, debt ceiling is going to come up later on in the year. If they truly say no, the House does not move, and they will not allow the debt ceiling to go up, it's going to be a mess. I guarantee it's going to be a mess. Hopefully it won't be that crazy. It remains to be seen. As for here in the state, well, again, while it is true revenues are going up in the state for all states overall, at the same time, a lot of federal support has been cut back, the net result of which is deficit positions have put into place. Here in California, last year we passed Prop 30, and I know I'm going over time. I'm going to spend a couple minutes talking about Prop 30 because I think it's important. First of all, is Prop 30 good? The answer in the short run, it is. Because now we have a balanced budget, now you're going to see an increase in government spending, and more or less that will offset the negative hit to the economy. Keep in mind, when you tax folks, you can't just look at the negative impact of taxes, you have to look at the positive impact of government, which a lot of these guys don't. If you balance it, if you look at the increase, the hit to the economy because of taxes, and the positive of the economy because of increased government spending, they offset. Indeed, in this case, they come in modestly positive on the side of overall growth. So that's good. Why Prop 30 doesn't bother me. Again, these are the reasons why it doesn't bother me. I can come back to why it bothers me in just a second. But here's why it doesn't bother me. Because we're a high-tax state. I will say this again and again and again. We are not a high-tax state. We are a stupid tax state. We're not a high-tax state, folks. You look at taxes and fees as a percent of income. What rank are we in the U.S. today? 16. 16. That's not number 1, number 2, or number 5. 16. Yet again, another survey came out, again, by our laugher, no doubt, talking about how we're the worst tax state. We're not. We're not even close. Who's the highest tax state in the U.S., by the way? I love this. Not New York? No, you got to think completely ironic. Just go pure irony. Alaska. Sarah Palin's hometown. I know it's hard to believe, but keep in mind, they have something called an extraction tax on oil. As a result of that, they get more taxes and fees as a percent of the economy than any other state government, to which they turn around and hand those out to people in the form of checks. It's the biggest welfare state in the union. Sarah Palin's hometown town. Really, honestly? Do we have no sense of irony anymore? None, right? And of course, we don't have an extraction tax, which goes back to the stupidity of our system. It's ridiculous. And of course, because rich people are going to leave. That's right. I'm leaving now. Folks, California's been expensive forever. California's never been a cheap state. If you were going to leave, you'd be gone, okay? You can buy 3 mansions for the cost of 1 mansion in Texas, okay? Easy, just go. Bye. So why Prop 30 does bother me? Why? Because it makes us more reliant on unreliable sources. We're going to have a surplus this year. That scares me to death. They're already talking about how fast can we spend this? What programs can we bring in? Folks, this is a burst in taxes because of the huge increase in capital gains. That's temporary. And they are already wanting to increase permanent expenditures on the basis of that. We went through this last time. Not to mention the fact back in 1998, Gray Davis and Company saw fit to undo all the pension reforms that Pete Wilson put into place. And here we are at the same place, having to desperately deal with pension reform. They're not even going to look at it now that we have a quote-unquote surplus. We need real reform, fair taxes on a broader basis, because we voted in without any expenditure reforms. And of course, last but not least, we haven't fixed the pension system. We don't have a budget surplus. If CalPERS actually told city and the state what they owe to get their pensions funded fully, it would be a fiscal disaster out there, okay? We're still lying to ourselves. We have to face that particular fact. As for interest rates, still relatively low. Keep in mind, interest rates ultimately are driven by supply and demand for capital. There's a lot more supply than there is demand in the world. Simple as that. That means low rates are here for us to stay. I would argue they're lower than they will be in a long-run basis, largely because we're still in a fair economy. If you look at a lot of the numbers having to do with, say, the 20-year to 5-year treasury yield spread, capex ratios, equity market spreads, these all suggest the economy is almost still in a recession. People are still afraid. There's still a lot of money sitting in treasuries because of being afraid of being invested in the broader economy, in large part because every 3 months you have some clown standing up and screaming it's the end of the world again. Well, that will start to come to an end at the part of this year. You're going to see interest rates start to drift up, but they're not going to go anywhere high. We're talking 50 bips, maybe 100 bips on the outside. The only thing that's going to drive them really high is inflation. There's absolutely no sign of inflation right now, in large part because the vast majority of cash being put into the economy is still sitting in the bank's foreign excess reserve. Ben Bernanke has plenty of room to maneuver on this front, but nevertheless, next year, you're going to see the equivalent backtracking of monetary policy as going through fiscal policy today. By the way, these were all predictable. Whenever you use these policies, they're always temporary stops to assuage some of the pain of the economic downturn. They have to then be reversed later on. They're never permanent fixes. They're only aspirin. Ultimately, there always has to be some payback. I know, I'm an economist, visible science, there is no free lunch, and that's the case here. But look for next year. The Feds are already talking about unwinding, and they're going to go through it today. I don't think it's a big deal, candidly, except for from a confidence standpoint. You already saw they gave a modestly mixed message, and the markets were wobbling all over the map again. They're going to have to go through it as simple as that. So what is the date? 2013, we've yet to fully deal with the deficit, but I'm looking for a 3% year, unless they have some craziness on the debt ceiling. Consumers continue to spend after this, so I think a weak second quarter. Housing recovery is going to continue to move forward and going to drive all sorts of wonderful things in the economy. Commercial will continue its slow recovery. Exports business spending will continue. Watch for increase in treasuries toward the end of the year, and Fed moves end of this year, beginning of next year. Future issues, we still have to deal with these entitlement reforms. We still have to watch out for that debt ceiling. Of course, Europe could still heat up, freaking the financial markets out. But on balance, I think all the numbers are great, folks. Last year I said this, year before I said this, I said, look, the numbers are still flat. When you look at the underlying fundamentals, you're turning the corner. You've turned the corner, simple as that. The East Bay is doing great, we're going to continue to do great, and ultimately what that means is you've got to start looking forward again. And yes, that means getting down to dirt, working with Karen, and deal with some of these fundamental issues on CEQA reform, on housing reform, because now is the time we have to start laying out the framework for the continued growth and expansion and prosperity of the California economy. Crisis is gone, but we still have lots of long-term issues to deal with. Thanks.